Clever Dave here. Well, today I'm coming in with a video that's a little bit late, and it's actually part 3 of the machine learning video, and also it's yeah, I'm kind of sad that when yesterday I said, we might be seeing a crash coming soon, or a strong downward correction from the models I was building yesterday. uh, and we saw it happen. So it doesn't really make me very happy that it happened, but anyways, it does, like, well, I said it, and but I'll go through a little bit about what really the model does. I've been doing a lot of tests with the model. You can see I've been updating the files with a lot of more data, and I've been working on different types of predictors to see if any of this stuff that's coming out of the computer and out of these machine learning algorithms is useful. And I've noticed a few things. And one of the things I want to show you was that uh, for the algorithm, it's not a crystal ball, but it does have some properties that make it useful. One of the first properties is that in the short term, it's able to tell you if things are going according to plan or normality, right? So what does it mean by things are normal? Well, when it predicts that things are normal, it's saying that, how would you say it? When it makes a normal prediction, it expects the accuracy of the prediction to be relatively high. And typically in the one-day prediction model, there's not so many external events. So actually the machine learning algorithm is pretty good at predicting the next price of the next day if there's no external events. And it can do it with almost a 99% plus accuracy. I can show you here. On average, across the board, when there are no external events, it's above 99% accuracy. And when there are on days where there are absolutely no external events and it's just purely, I would say, markets trading themselves, it appears to be even at 99.5% and be even good at predicting the direction of the markets. But those type of days, from what I can identify, happen maybe on average 1 in 2 days, and you cannot predict that it's going to be a day that's going to be uneventful and there's going to be no external factors affecting the price of gold. So yeah, so that's one of the reasons why it's very hard to predict markets, because even if you make a very accurate predictor based upon all internal events to the market, you can't account for external events, and then you have quite a big variability. I mean, in terms of context, right? For you to make really money off of being able to predict the future with a machine, you need to have around a 95% plus, a 99.5% plus accuracy, and this accuracy has to be consistent. I would say at least 50% of the time. And right now, with what I've built here, I've gotten to about a quarter of the time. I mean, I've been working on this for 3 days in my spare time. So in roughly, I would say a day's work, I'm able to like bring it up to around 24% of the time I can predict with 99.5% accuracy, and I can tell maybe 55% of the time when there will be a day without too much external market factors, right? And the algorithm will be extremely performant on that day. It's usually if you have a sequence of at least 5 mispredicts, that means that the accuracy is below 5%. it's very improbable that you have a sixth day of continuation. On average, it's usually 5 with a deviation of 2. I think that's what I two something. Anyways, you don't have to worry too much about it. It's just that it's very unlikely that you have like 7 trading days where the market forces are not strong enough to make that the model works perfectly relative, and the external factors are relatively low. However, you don't really know what day. I've seen in here, despite the fact that it says that it's really improbable. There are days there's 12 days maybe where the model completely fails. They have a sequence like that, and they're rare, but they do happen. So if you were expecting to make money doing that way, then it would be quite difficult. But the interesting thing is today we have a huge drop in price, and we had the vaccine news that AstraZeneca would be releasing a new vaccine, and this vaccine actually is much easier to distribute than the 2 other vaccines, and is made with more traditional technology and provides a good response rate in elderly people and has a decent efficacy rate of 90% plus. I mean, it's not 95% plus, but you don't need to freeze it, so it's actually going to be much easier to distribute, and it's cheaper. So the gold market reacted to this news, and obviously gold took a beating. We're at the 1830 level, 1838 level. The predictor predicted that there will actually be a little bit of a rise of gold, or even will be more or less sideways. But this is the short-term predictor. The short-term predictor, actually, in the new one I made, it takes into consideration the MACD and also the RSI. And in both of those, especially the RSI, is indicating that we are in oversold territory. We were already in oversold territory in 1881. However, the trend is, this is the thing with the RSI, is that if you have a bear trend, it becomes it can be a bit misleading, and your RSI can actually, you can stabilize at a lower price, because it is the average prices of ups and downs over the last 14 days. So if your up and downs, are on lower price ranges, and you have up and downs, and it's pretty much flat on that lower price range, it will start to weaken, and it'll start to say you've consolidated within that lower price range. And I think we're going to see that. We're seeing that somewhat in the, if you look at what type of formation we're making, we are making what they call a 4 formation, but mainly what you're seeing is a downward trend. The black line, this line is the I believe the 60-day moving average, and there's a 30-day exponential moving average, which is the blue line, and the red line is the 12-day exponential moving average. And you can see that they are dragging away. That means that the 60-day normal moving average is going down slower than the 30-day exponential moving average, which is kind of almost dropping down a cliff. And then really the 12-day is really dropping down, especially due to today's price shock. I think we'll see further sell-offs. I mean, if you look at this trend, obviously I would say the next support level is we have some at 1800, and we have some at 1680, 1650. So, and we haven't really broken down this sort of upward 1950. I don't even think in the short term it's very likely we'll see that. Most likely we'll see that it'll rise, it'll go down, it'll rise, it'll go down. It's going to go towards 1800s or 1700s. And this is my second point I want to bring up. The second point is I wanted to bring up is the 112-day predictor. And what I've noticed in the 112-day predictor is it has a tendency to amplify the trend. And it's not such a great predictor in terms of predicting the actual price that it will be on a specific date, right? Because it gets them wrong at certain points. But it's very good at predicting the trend. And this is something I've noticed. If I go back to like 120 days to any point over here, and I look at, the last trend it was going to go towards, it amplifies the trend. So I would say that You can see here in this August period, because the trend, it was going to start slowing down. It started predicting that, you might see a slowdown in September. And we did see a small slowdown, although it was at another level. And the 112-day predictor is not very accurate. So sometimes you have huge divergences. Like it predicts that you will be at a much lower level. Potentially, it did predict you would be at a much lower level due to the some economic factors here. But then you could have a positive shock that brings it all the way up. And then what it would do is say that, oh, we price in the new positive shock, and if you continue on the new positive shock, you will reach the in October the 1,500 level, which it did. If you look at how the actual chart evolved, and then how the actual price evolved, and then from this point on, it was looking at, for example, that after the initial shock, what will happen? Well, most likely the price will adjust. We see some sell-off, but then we have more external shocks, and right now we're kind of running out of external shocks. I mean, for there to be a positive shock to the price of gold, we would need either a massive amount of stimulus, potentially a crash in the stock market, massive unemployment. I mean, it's all building up to that. And but if things stay the same, that means there's no stimulus, there's deadlock in Congress and government. There's going to be, how would you say it? There's going to be rising stock markets, which is the case right now. And also, like, even with stimulus and low interest rates, a lot of it does go back into the stock market. It doesn't really always go into gold or inflation. If you look at how, basically, like, here's the thing. I think that when it's low inflation and you do have a small rise in the price in the yields, stock markets react quite violently, and the violent downturn tends to lead to a nice upturn in gold. And I think until next year, we are going to see much lower prices. And when I did my prediction yesterday, God, I thought I didn't think it would come true. I thought that we would start seeing lower prices, and I was thinking, yeah, we are going trending from this point on. So from last week when we were at 1860, right? The predictor predicted that in the future we would see 1600 level gold. That means in March. And you're like, yeah, but your predictor also said that we would see 1800 level type price of gold starting from July last year, which we kind of did. We're like 1830 right now. We'll probably go lower. No, sorry, we will see 2000 level gold. But you have to remember that back in July, we're going to get one QE, and the market pricing that we will get multiple QEs. And the external shock, the market's changed, especially over the last few days. Mnuchin just like castrated the Federal Reserve. So it's a very interesting thing. But starting from, I would say, yesterday when I finished building the initial version of this model, this one has both the RSI and the MACD for the short-term changes taken into consideration, and it does revise a little bit its estimates to the upside based upon those factors. And it does believe still that we would see 1700 level gold, 1600 level gold before we see more upside movement of gold. I think what it's saying is, here's what it's saying. It's not saying that we will definitely see 1700 level gold, right? But we are on a downward trend, and we should not be surprised to see downward adjustments. However, here's what I'm going to say. A downward trend is a buying opportunity. What you need to do is just ease in slowly and start buying a little bit, because sooner or later, the more the United States government delays stimulus action, the worse it will be when they will have to do it. Because when they will have to do it, they will have to make up for all the missed stimulus that was required maybe less was required a few months ago. Now more is required because more people have permanently lost their jobs. So it's we'll see. It's a very difficult time to predict. It's just that everything's uncertain. And will I keep on working on these models to make them more accurate? I think I will. It's quite an interesting thing because, you know, we do chart reading and we believe that, you know, certain charts leave certain formations, and that is a form of pattern reading. And with machine learning, you can do more extensive pattern learning or pattern reading that tends to be more or less accurate. Especially what I was surprised was is the 1 day readings, which tend to tell you that, you know, most of the time that it's flat, and then occasionally it tells you that, you know, you're moving upwards. So if you're able to combine the two and you have like good, I guess, good technical skills, in addition you're using this as an additional tool for guidance, you know, especially if it reads more macroeconomic trends, it could be a good tool. The most days I found that were most predictive and most useful was the 112 days, which surprisingly tells you the long-term trend based upon the current like situation. Of course, it can't tell you what's going to happen 50 days away from today, because between here and 120 days, maybe on the 50-day, you know, there's a vaccine that comes out or there's a new pandemic. You cannot tell. The longer you, like I said, it's like a baseball, you know, pitcher. The further he has to throw, the less accurate he'll become. And but he can tell you the general direction it's going right now. He's going to pitch, and if you look at the general direction based on what we know, at least over the past few, I would say the past few months, um, I would revise all the numbers downwards. Maybe not so much towards the like 1650 levels, but at least to the 1700 levels in the midterm. If you ask me, were there times when it predicted upward trends? Yes, it did. But you would have to, I think, overall, you have to combine the two, right? You have to combine the midterm trend, the long-term trend with the midterm trend. And when the two are aligned, you know that the market is running in sort of what you're going to predict. There's maybe, if both are moving upwards, then most likely you're in a bull market, you know, and it consistently predicts upward trends. That's potentially a time. And also the short-term trend is also predicting that there's consistent upward movement. It will confirm that you're in a bull market, and you have quite a lot of macroeconomic factors that are conducive to you being in a bull market. However, now right now, I'm seeing the opposite. I'm seeing that, you know, there's a divergence in the model precision, especially for 1 day. It's becoming very inaccurate, and I'm seeing that in the 112 days, I'm consistently getting a lower price in the future predicted price, which means that it most likely is going to go, I would say, trend downwards. And also you have to remember that this, while it sets a specific date based on today's information, it's more accurate to say that it's more of a range. You know, it expects that next March to be somewhere in the 1670 level. The average is 1670. And then sometime in February next year, we should see the 1700 levels, which is around here. Let's see, we should see 1750. Despite the fact that in July we were seeing more 1850, 1900s. So I think it's relatively accurate in terms of its general projected direction. And I can see that too in technical analysis. The only thing that might be misleading, and if you are trying to see, it doesn't let me. Okay, let's remove this moving average. Now we're going to see. Okay. You have 3 charts. We are in very oversold territory, but I think we'll have a small buyback, and then it'll go up a little bit. We won't see we might see 1850s, 1860s, and this will come back down, 1817 1800s level. It's going to test that. It's going to probably break it. And then most likely we'll see 1700s. Not so much in January, but maybe around February, beginning February. And most likely, if there's an external shock, for example, that this is when Joe Biden will get confirmed, and then we have all the policies rolled out, and those policies are conducive to a bull market for gold, then we'll see quite a strong upside. However, until then, it's very difficult to say. It's more likely that we're in a bear market. I said it, I think, almost a week ago. I was telling people most likely we're in a downward trend in a bear market, and I spent a lot of time building this, trying to rework the code for the machine learning predictor. And what I have is actually, I've built out multiple regression predictors and multiple machine learning systems out here, and I had to rework a little bit the RSI. So it calculates RSI, creates the RSI in the base data. It creates the MACD. You can look at it, makes more moving averages so that you have the correct data and the trends for the long term and the short term. Maybe I'll do a longer term MACD where I can take like the 50-day and the 100-day as a long term MACD, and then take a longer term RSI too, because right now I'm doing a 14-day RSI. It's pretty interesting that actually you can get some useful information, and there's some insights that you can get out of machine learning. And remember, this is just a short-term price change. My personal stacking plan, I've planned it out. I can show you. I did this yesterday, and I was planning, we would see 1700, and I'll start easing in the 1700 range, and I'll be buying probably one. Hopefully, I'm saying that after the 27th, we're going to probably see 1700 range. After the 11th, 1700 range. If it's still there, I'll increase my budget. If it's in the 1600 range, I'll start buying 1 ounce, 1 pure ounce. 1600 range, probably buy 800. I have other bills, and it's also for my cash flow management. And if it really stays at 1600 and goes to and stays for a long period in 1600s, I'll buy 1 ounce every single time, and it will be a good deal, because that 1600 gold is pretty affordable relative to other assets out there, especially considering that it's insurance against the current EV bubble that we're seeing. Anybody who names themselves as an electrical battery company right now, their stocks are going through the roof. And part of the reason for that is, one, hubris. Two, we have ETFs that don't require that these guys keep making money. You only need to make money to qualify for an ETF. You don't have to keep making money to be qualified to be put into an index. So that's something you have to think about. And if indexes crash, it's a huge market of passive funds. They represent, I think, if they crash, it will be worse than the housing market crisis crash, where you had NBSs. So that's what I wanted to talk about. It's a short video, and click the like button, subscribe for daily content. I'll be posting more about this machine learning stuff. Maybe not tomorrow. I've got quite a bit of work tomorrow. Probably, I might have 2 days where I'm not doing any videos, but most likely Friday I'll post new content. Thank you very much for watching. Dave out.